There are 7 IRS rules that change the moment you retire, and nobody at your company, nobody at Social Security, and nobody at the IRS is going to explain a single one of them to you on your last day of work. When you had a job, your employer pulled taxes out of every paycheck and sent the money to the IRS before you ever saw it. You filed once a year, maybe got a refund, maybe owed a little, and the system ran itself. The day you retire, that entire system shuts off. There is no letter, there is no checklist, there is no phone call. You go from autopilot to a system where every single tax decision is yours and every single mistake has a price. But here's what makes this dangerous. There is one rule on this list, rule number 6, that opens a window the day you retire and closes it the day you turn 73. Most retirees never hear about this window until after it shuts. The ones who use it save over $50,000. The ones who miss it pay full price for the rest of their lives. We will get there, but first you need the full picture. Here are all 7 rules in the order the IRS expects you to deal with them. Rule number 1. The IRS will charge you a penalty every single quarter you do not pay them on time. When your employer withheld taxes from your paycheck, that money went to the IRS throughout the year. In retirement, your income comes from Social Security, a pension, IRA withdrawals, dividends, maybe rental income, but most of those sources either withhold nothing or withhold nowhere near enough. Social Security only withholds federal tax if you specifically ask for it. IRA withdrawals often default to 10% withholding, but your actual tax rate might be 22%. If the gap between what you owe and what was withheld is too large, the IRS charges an underpayment penalty. The rate for the second quarter of 2026 is 6%, calculated daily on the amount you underpaid for each quarter. Here is what that looks like. In dollars, say your total tax bill for 2026 is $14,000. You had $8,000 withheld from various sources throughout the year. That leaves $6,000 short. You did not make estimated payments because nobody told you to. The IRS calculates the penalty on that $6,000 across 4 quarters. You are looking at $300 to $400 on top of the $6,000 you already owe. The fix is quarterly estimated tax payments. The deadlines are April 15th, June 15th, September 15th, and January 15th. You can set them up at irs.gov. The Safe Harbor rule says if you pay at least 100% of last year's total tax through withholding and estimated payments combined, you will not be penalized no matter what you owe this year. If your income was above $150,000, that number is 110%. But here's the part almost no new retiree knows. The IRS has a specific waiver for people 62 and older who retired in the last 2 years. If you had reasonable cause for underpaying, they can waive the entire penalty, but they do not apply it automatically. You have to file Form 2210 with your return and check the box yourself. If you just pay the bill without filing that form, you will pay the penalty and never know the waiver existed. If that penalty surprises you, the next rule is worse because it affects money you thought was already yours. Rule number 2, up to 85% of your Social Security can be taxed, and the formula that decides how much has not been updated since 1993. Most retirees find this out the hard way. They get their first Social Security check, assume it is tax-free, and then April comes, and they owe the IRS thousands of dollars they did not expect. The IRS uses something called provisional income to decide how much of your Social Security gets taxed. It is your adjusted gross income plus any tax-exempt interest plus half of your Social Security benefits. If that total is between $25,000 and $34,000 as a single filer, up to 50% of your benefits are taxable. Above $34,000, up to 85%. For married couples, the thresholds are $32,000 and $44,000. Those thresholds were set in 1983 and 1993. They have never been adjusted for inflation. A combined income of $25,000 in 1983 meant you were comfortable. Today, it is barely scraping by. Therefore, this frozen threshold now catches 56% of all Social Security recipients. But the real trap is what happens at the edges. Every extra dollar of income you bring in does not just get taxed at its own rate. It can push more of your Social Security into the taxable zone. The effective marginal tax rate for retirees in this income range can hit 40 to 50%, not because the tax bracket is that high, but because each new dollar triggers tax on benefits that were previously untaxed. The fix is to file Form W-4V with the Social Security Administration. It takes 5 minutes. You choose a flat withholding rate of 7, 10, 12, or 22%, and that money comes out of your check before you ever see it. It does not solve the underlying formula, but it stops the surprise bill in April. You can also set it up online through your My Social Security account. Now, before we get to rule number 3, I need you to pay close attention because this next one is brand new. It did not exist until this year, and most tax software is not flagging it automatically. Rule number 3, there is a brand new $6,000 deduction for seniors, and the IRS will keep every penny of it if you do not specifically ask for it on your return. The One Big Beautiful Bill created a new deduction specifically for taxpayers 65 and older. It is $6,000 per person, $12,000 for a married couple filing jointly where both spouses qualify. This is on top of the regular standard deduction and on top of the existing additional standard deduction for seniors. The income limits are $75,000 for single filers and $150,000 for married couples. Below those limits, you get the full amount. Above them, it phases out. This deduction is available for tax years 2025 through 2028. It goes on the new Schedule 1A, but here is the problem. Not all tax preparation software has been updated to include it. Not all preparers are flagging it. Therefore, if you already filed your 2025 return without it, you can amend within 3 years and claim the money back. If you have not filed yet, ask your preparer specifically whether they applied the senior bonus deduction on Schedule 1A. Do not assume they did. For a married couple, both over 65 and under the income limit, this is $12,000 in additional deductions over 4 years at a 22% tax rate. That is $2,640 back in your pocket that the IRS will keep if you do not ask for it. That is free money sitting on the table, but the next rule is about money the IRS will take from you if you are even 1 day late. Rule number 4, your required minimum distributions start at 73, and the penalty for missing one is 25% of whatever you fail to withdraw. If you have a traditional IRA or a 401k, the IRS requires you to start taking minimum withdrawals at age 73. The amount is based on your account balance on December 31st of the prior year divided by a life expectancy factor from the IRS tables. You must take your first required minimum distribution by April 1st of the year after you turn 73. Every distribution after that is due by December 31st of each year. If you miss the deadline, the penalty is 25% of the amount you should have withdrawn. It drops to 10% if you correct it within 2 years, but that is still a massive penalty on money you were going to take out anyway. But here is where the real damage happens, and most retirees walk right into it. If you delay your first distribution to that April 1st deadline, you will have to take 2 distributions in the same calendar year. Your first one before April 1st and your second one before December 31st. On a $500,000 IRA, that is roughly $38,000 in withdrawals hitting your tax return in a single year. That can push you into a higher bracket, make more of your Social Security taxable under the formula I just explained, and trigger the Medicare surcharge I am going to cover in rule number 7. Take your first distribution in the year you turn 73. Do not wait until April. The deadline is a trap. Speaking of those required distributions, there is a way to satisfy them without paying a single dollar in tax, and almost nobody does it. Rule number 5. You can use a qualified charitable distribution to pay your required minimum distribution with 0 tax. If you are 70 and a half or older, you can donate up to $111,000 directly from your IRA to a qualifying charity. This is called a qualified charitable distribution. The money has to move directly from your IRA custodian to the charity. If the check comes to you first and you deposit it, the IRS treats the whole thing as a regular taxable withdrawal and the tax break disappears. The donation counts toward your required minimum distribution, but it does not count as taxable income. It does not increase your adjusted gross income. It does not push your Social Security into the taxable zone. It does not trigger the Medicare surcharge. If you were going to give to charity anyway, routing it through a qualified charitable distribution instead of writing a check from your bank account saves you thousands of dollars for the exact same donation. Same money to the same charity, but one way costs you nothing in tax and the other way costs you plenty. Now, we are at rule number 6. This is the one I told you about at the beginning. This is the window that opens the day you retire and closes the day your required minimum distributions begin. If you miss it, you cannot go back. Rule number 6. The years between retirement and age 73 are the most valuable tax planning window of your entire life. and most people waste every single one of them. These are called the gap years. During this window, your income is often at its lowest point. Your tax bracket is at its lowest point. This is the optimal time to do Roth conversions. When you convert money from a traditional IRA to a Roth IRA, you pay income tax on the amount you convert in that year. But once it is in the Roth, it grows tax-free, withdrawals are tax-free, and there are no required minimum distributions on a Roth during your lifetime. The tax you pay now at a lower rate saves you from paying a higher effective rate later when Social Security required distributions and the Medicare surcharge all stack on top of each other. Here is the math. Say you convert $50,000 per year for 6 years during your gap window. That is $300,000 moved from your traditional IRA to your Roth at a 12 or 22% rate. If you had waited until 73 when required distributions forced the money out anyway, that same $300,000 comes out at a 24 or 32% rate because it stacks on top of Social Security and every other income source. At a 10% difference in tax rate, that is $30,000 saved, but the Roth keeps growing tax-free for the rest of your life, and your heirs inherit it tax-free. Over 20 years, the total benefit can exceed $50,000. In a down market like we have right now, conversions are even more powerful. You convert at a lower dollar amount, pay less tax, and all the recovery growth happens inside the Roth where the IRS cannot touch it. But every year you wait is a year of conversions you cannot get back. The window closes at 73. Talk to a tax advisor this week about filling your current bracket with Roth conversions. Do not wait until next year. There is one more rule, and this one does not come from the IRS. It comes from Medicare, but it is triggered by everything I just told you, and it is the surcharge that blindsides more retirees than any other. Rule number 7, a single large withdrawal or conversion can raise your Medicare premiums by over $4,000 a year, and Medicare will not warn you before it happens. IRMAA is the income-related monthly adjustment amount. If your modified adjusted gross income exceeds certain thresholds, Medicare adds a surcharge to your Part B and Part D premium. The surcharge is based on your tax return from 2 years prior. This is the part that catches retirees off guard. The income that decides of your 2026 Medicare surcharge is the income you reported on your 2024 tax return. You can be fully retired with almost no income today and still be paying the highest surcharge because of one large event 2 years ago. For 2026, the first threshold is $106,000 for individuals and $212,000 for married couples. Above those levels, your Medicare premiums can increase by $70 to over $400 per month per person. Therefore, a single large IRA withdrawal, a Roth conversion that was too aggressive, or a one-time capital gain from selling a property can push you over the threshold for 1 year and raise your Medicare premiums for the following 12 months. For a married couple in the second IRMAA tier, the surcharge is over $4,800 per year for coverage that is identical to what someone below the threshold pays. If this happens because of a one-time event like a retirement, a job loss, or the death of a spouse, you can file Form SSA 44 with the Social Security Administration to request a reduction. But Medicare will not tell you this form exists. You have to know to ask. Here is what you do this week. First, check whether you need to make quarterly estimated tax payments. If you have any income that does not have taxes withheld, the answer is yes. Set them up at irs.gov before the next deadline. Second, file Form W-4V with Social Security to start withholding from your benefits. Third, ask your tax preparer whether they applied the $6,000 senior bonus deduction. If they did not, amend your return. Fourth, look up your required minimum distribution start date and plan to take your first one in the calendar year you turn 73, not the following April. Fifth, call a tax advisor and ask specifically about Roth conversions during your gap years. Every year you wait is a year you lose. Sixth, before making any large withdrawal or conversion, check whether it will push you over the IRMAA threshold and raise your Medicare premiums for the next 12 months. The IRS is not going to call you. Medicare is not going to warn you. The system that ran on autopilot your entire career just handed you the controls, and the first mistake is the most expensive one.